If you've ever wondered how you can trade during earnings without blowing up your account, this video is for you. I'm going to walk you through a real trade that I placed on Google just a couple of days ago. I sold 5 put option contracts on Google just hours before their earnings came out. And I'm going to show you why I took this trade, what the risks of the trade were, and how you can evaluate a trade like this step by step. Earnings season can be such a goldmine for option sellers, but only if you know how to manage the extra risk that comes with it. Today, I'm going to break down one of my most recent trades on Google so you can see exactly how I approach selling put options around earnings with real money on the line. So here's the trade. I sold 5 put option contracts on Google with a $185 strike price, expiring on July 25th. Now, mind you, I sold these put options on Wednesday, July 23rd, just a few hours before their earnings came out. And I collected a total of $3.09 per contract, which comes out to a total of $1,545 in total premium. My break-even price on the trade was $181.95. Google was currently trading at about $190.20 when I placed this trade. In simple terms, I am agreeing to buy 500 shares of Google at $185 if the stock drops below that price by the expiration date. If it stays above the strike price of $185, I don't have to buy the shares and I just keep the premium. And here's why earnings make this strategy very risky, but very profitable. High IV equals high premiums. Now, what makes this trade unique is that I sold it right before the earnings. And during earnings season, implied volatility spikes. That means that the option premiums go up through the roof. And as an option seller, that is a really good thing. But volatility also means uncertainty. A bad earnings report could drop a stock 5%, maybe 10%, or even more overnight. That's the risk that you take. For a good example of this, just take a look at Chipotle stock. Their earnings didn't go their way, and the stock has plummeted. Before placing this trade, here's what I considered. Do I really want to own shares of Google for the long term? For my case, it's a simple yes. It's Google. Is the strike price far enough below the current stock price? Yep, it's $5 a share below, and I got earnings coming out today. I like it. Can I handle the process of being assigned if I do got to buy the 500 shares? Yep, I got the money on the sideline to do it. And also, what's my conviction level? Google will do really well with their earnings. My conviction level was really high. I felt really good about their earnings outcome. About 2 weeks ago, I even made a video on how undervalued I thought Google was currently trading. I even talked about their net income and how much free cash flow they had on hand. And as a safety precaution, just in case the earnings were not going to come in as good as I thought they were going to come in, I sold the put options at a strike price where I feel comfortable buying the shares at. And regardless on whether I get assigned the shares or not, I'm still going to pocket that fat, juicy premium. And as of right now, in just a single day of placing this trade, I've already collected over 92% of this contract. I received an average credit here of $3.09 per contract, and it's currently only worth 23 cents. So if I want to get out of this trade right now, all I have to do is give them back 23 cents per contract. And by doing that, I can wipe my hands clean of this trade and just get out of the trade altogether and pocket the majority of the premium. But I'm not going to do that because I am hoping that by a miracle of God, I can buy these 500 shares at the strike price of $185. And if I don't end up buying the 500 shares at this strike price, I'll just let this contract expire worthless and I'll collect the full 100% of the premium. So what actually happens if I do get assigned these 500 shares? If Google drops below $185 by the time this expires, I will get assigned those 500 shares. And I am completely fine with that because I believe in this company for the long term. Once assigned, I can turn around and sell covered calls to generate more income and lower my cost basis. That is called the wheel strategy. And this trade that we did here today, that's just one side of it. Key takeaways. Let's recap what you should learn from this trade. Number 1, earnings boost premiums, but they also come with increased risk. Number 2, only sell puts on stocks that you're happy to own. Number 3, choose a strike price with a solid buffer. Number 4, know your break-even price. Number 5, please make sure you have the cash on hand in case you do get assigned the shares. And number 6, focus on your long-term goals and strategy. Don't just focus on the short-term fear. If this video helped you understand how to sell puts during earnings, please do me a favor and let me know down in the comments. And if you want to see more real trades, learn the wheel strategy, and grow your passive income, hit that subscribe button while you're at it. And if you want to practice this for yourself, start small, stay smart, and always know your plan before placing the trade. With that being said, I want to thank you guys for hanging out with me for a few minutes today, and I will catch you on the next one. Peace.